Hello, I'm Troy Harmon. Here with me is Nick Antonucci and Jacob Keene. This is your market update from Henssler Financial for the month of April 2018. So guys, let's just dive right into it. We've seen a little volatility in the market. We've seen tariffs. What is going on?
Yeah, I think a lot of what's driven the volatility in the market, specifically through March, has been the announcement of these new tariffs from the Trump administration. It started with what would be initially $50 billion in tariffs imposed on China, which is now, as of Thursday night, escalated to potentially $150 billion as the president came out and announced he may impose an additional $100 billion in tariffs. Whether or not that comes to fruition is still to be seen, but nonetheless, the market is reacting and tends to be negatively reacting to those tariffs, as it's no surprise that that's a negative reaction.
Yeah, and we've seen overall in the year volatility on the rise. I mean, we're on the backs of a 2017, which was really almost an anomaly when you got greater than 20% returns, not a lot of drawdowns. Now we've faced basically two 10% drawdowns here in U.S. equities, negative on the year right now. It feels like a new regime. We've got rising rates. We've got new fiscal policy out. So there's a lot of pressure in the market, and a lot of market watchers were awaiting this jobs report.
Yeah, which we got today, Friday. And it was not a terrible report. It did miss expectations. 103,000 jobs were added to the economy. In the month of March, the expectation was for 178,000, so missed there. Also forecasted was the unemployment rate to fall to 4%. It remained at 4.1%, where it's been for a considerable amount of time now. Then you also had January and February's results revised down by 50,000. So a number of jobs added were revised down by 50,000. So it wasn't a disaster of a report by any means. We still added 103,000, but it wasn't quite as rosy as economists had forecasted.
Right. It was a little soft, and the wage growth number was actually right there in the range.
It was 0.3% for the month and 2.7% year over year.
Right. Absolutely. So it's kind of the story there is we're worried about inflation. Overall, the market's worried about inflation. It's been driving rates. In March, we got a Fed hike.
Right.
We saw that move, into the beginning of the year in February, move up in rates about 30, 40 basis points. We've come off that a little bit. We've been in a range for the past 3 months, and at the same time, we've seen LIBOR increasing. So it's kind of the story here between rates and tariffs. I mean, that's kind of what's scaring the market, making it feel a little uneasy here.
Looking ahead, I'll be honest with you, I don't think the tariff issue goes away. I think really, though, you didn't talk about it, but China retaliated in kind.
$50 billion in tariffs of their own imposed on us.
Almost the exact dollar amounts. Some of the things that they did initially was fruits and pork and soybeans they've actually added later. SUVs, sport utility vehicles. They've also talked about aircraft, which could be very difficult for some of the corporations in the United States.
Absolutely.
Boeing specifically.
And I'm curious to see, and how long does it take for China to come back out now and say, oh, well, we're going to impose up to 150 billion, kind of a tit for tat with what the U.S. is doing.
Yeah, exactly. And they will. I think they really will. The one thing that you're probably looking at, though, is this is more of a negotiation tactic. And that's what some of the newcomers to the Trump administration are actually saying. We don't really intend to put tariffs in the market. What we're seeing is just a way to get them to the table, and we'll talk about things that we have viewed as unfair for a long time.
Sure.
That said, it still causes volatility in the market. Some of the Trump administration upheaval where we've had 22 people come and go, some fired, some quit. That's probably not the most settling thing for markets. Got a little bit of inflation and expectations of inflation coming. But really, the fundamentals are pretty solid. We got GDP at 2.9% in our first quarter. Don't know what the final expectation is, but it was better than expected initially. Inflation, like I said, is expected to tick up maybe 2.1%. That's the headline. Core still around 1.8, which is below the target. Corporate earnings, I think, is probably the big story.
Yeah, that's the story for
29% expectation, 29% growth in this year.
And we'll get a good idea of how that's going to play out in the coming weeks as we've wrapped up the first quarter, and we're going to start to see those earnings releases in the coming weeks.
Right, exactly. And I really think you focus on earnings. just make sure that if your portfolio needs a rebalance, I'd go ahead and do it now, no doubt. But I think the economic situation is fundamentally solid. We got tax reform that we don't know how that's going to react in the market, whether it be the corporations or individuals. Consumer spending is key to our economy, so we'll just have to wait and see what goes on there. But I really think we finished the year positive on the stock market, which, in the middle of this volatility gives you a little doubt.
Sure.
Thank you for watching. This has been your market update from Henssler Financial for the month of April 2018. We'll see you next time.